Well, how's it going, everyone? My name is Amos, and welcome back to the Dividend Compounders with Cheese channel. If you can't tell by the tone of my voice, this is going to be chill, okay? You can think of it as like a podcast. We're going to be talking about the companies that are reporting their earnings this week. As you can see on your screen right now, these are the big, the names that are doing it for each day of the week. And the earnings is essentially when a company gives you their financial progress of how their company operations have been doing for the past 90 days, but also they give you an update in their guidance for how they're going to do for the next 3 months up to a year. So I think it's really important to keep up to date with the companies that are on your watch list, or if they're in your portfolio, you should pay attention that much more, right? By the way, I'm kind of stoked because I just watched my Seattle Seahawks win, because this entire weekend, dude, all of my favorite teams were just getting battered and hammered and losing. So to at least have my Seahawks come out on top, I'm in a good mood. So if that sounds good with you, let's go ahead and get into it. And by the way, after we talk about the earnings of these companies, I'm also going to be giving you my thoughts and opinions on some Wall Street Journal articles that I read this morning. And I would encourage you to watch this video as kind of like a podcast, right? On your commute to work, if you're dropping a protein bar on the toilet, if you're doing the dishes, or you're working on something in your garage. Yeah. So let's see. Jump on over to stockanalysis.com to take a closer look at all the companies that are reporting on Monday. To be honest with you, I'm not interested in any of them. And I don't think anyone should be, right? I think the only one here that kind of sticks out to me is Newegg. Earlier this year, they went through a meme stock squeeze frenzy. This is a company that is basically selling computer parts as an alternative to Amazon, right? And they were trading for roughly, $4, $3 for most of 2025. And then when that squeeze opportunity happened, dude, they just shot up to the moon. They went up to $128 a share. But if you take a look at their fundamentals, it is absolutely trash, okay? So if anyone's buying into Newegg as a long-term investor, maybe I'm missing the mark. Maybe I'm not understanding. Well, what's so attractive about Newegg? They're unprofitable as a business, which means they're losing money in order to operate as a company. I mean, their bottom line, as of right now, negative $22 million. I think it's pretty gross. I'll be honest with you, though. I think leading up to 2014, I used to buy all of my laptops from Newegg, especially as a college student. Dude, back in like 2009, 2010, 2011, I feel like technological advances, especially for personal laptops for college students, it was evolving so quickly year after year. Like, you needed to buy another laptop in order to keep up with your coursework. So I think back then you had to replace your laptop frequently, but I think these days, I think you're good to go. You could at least get 3 years at a minimum out of your workstation. And I know there's some people that have like MacBook Pros and they're pushing like 8 years. Me, I have a Lenovo Legend, which is like a gaming laptop. I'm not a gamer, but as a video editor, I needed a computer that had pretty high specs, a dedicated graphics card for video rendering and whatnot. And I'm coming up on 5 years, and he's on his last leg, right? That's one of the first big purchases that I plan on doing once I visit the US. I could buy one here in Japan, but the prices for computers here in Japan, I don't think it's too fair. So I'm waiting until I can hop on over to the US to buy a new workstation. But yeah, just taking a look at their numbers, I just think this is disgusting. I don't see, do they even pay a dividend? I don't think they do, right? They don't pay a dividend. That's why there's no dividend tab. So on Monday, I don't think anybody should be paying close attention to earnings. None of these companies are that relevant. But on Tuesday, I mean, I think there's a few that stand out for me. You got CrowdStrike, you have Marvell. This is a company that I bought into at about $62 a share this year, and I sold out of it at $80. I thought it was a pretty good play. I mean, it wasn't the greatest. Yeah, I bought it at about like right here, and then I sold out of it right there for about 2 to 3 weeks. Not bad, right? This is a company where if anything goes wrong, I'm willing to buy back in. Essentially, you could think of Marvell as the West Virginian cousin to Broadcom. They're doing the exact same thing of making customizable AI chips for the hyperscalers, mostly Microsoft, Amazon, and Facebook. And obviously, AMD and NVIDIA, kings of that market, right? But I think we're starting to slowly realize that you don't need the greatest and the strongest AI chip for all of your cloud endeavors. And that's why the hyperscalers, they're partnering with Broadcom and Marvell. That way they can get chips produced that don't cost an arm and a leg, right? Because I think NVIDIA, they have pricing power in that if you want the greatest AI chip from NVIDIA, you're going to have to pay whatever they are charging. But by buying out customizable chips from their competition, they can save. And that should increase the margins for the hyperscalers. So the investing thesis for Marvell, for me, it's not a long-term buy and hold. They would love to buy into it. If it's okay, here's my game plan. I'm not telling anyone else what to do with your money. But me personally, if they report their earnings and they sell off, okay, for the past 5 days, they're up by 15%. Let's say something really bad happens in the earnings call and they drop off to like 75 or 74, I'm jumping in. I'm jumping in unless they say something that's counterintuitive to a quality company. If they say something like, hey guys, we're so sorry, but we're going to make the strategic pivot into becoming a frozen lunch company. We're going to sell frozen meals. If they say something like that, dude, I'm jumping ship and I do not want to go near them. But if they say something like, hey, we're crushing it, the numbers are looking pretty good, but we're going to have to shave the guidance by like 5 to 10%, and the market, from what I have noticed, since September and October and November, now that it's December the 1st here in Japan, it is at least, any single time a company slips up by a little bit, dude, they get hammered. And when I say hammered, I mean they go into the red by like 20% easily. So if that kind of emotional sell-off happens, I'm jumping in. I'm not telling you what to do, but it's what I'm personally going to do. So I'm going to be paying a close attention on Tuesday because I think it'll be a good opportunity for me to jump back into Marvell. And I'll do that repeat rinse cycle, buy the dip and sell after the pop with Marvell. And if they don't pop, like pop meaning rebound, I don't mind holding them for the long term because I think it's a pretty good company. And then something else that should stand out on Tuesday is GitLab. I mean, this is a company that's been on my watch list for a hot minute. My personal buy price is $38, okay? Right now they're $41, and I think if anything goes south on Tuesday, I think they have the opportunity to dip below that $38 price point, and I'm jumping in. Once again, I'm just sharing with you guys, full transparency, what I plan on doing. I'm not encouraging anyone else to copy me, right? So GitLab, they basically are a, I don't know how to describe it because I'm personally not a coder or a mobile app developer, but it's a platform where it's open source code where all of the developers can work on different apps together, if that makes sense. And for the longest time, I think Wall Street feels angry towards them because it's a very lucrative company. I mean, just look at the growth of their top line. But the CEO, the founder, he's more of like a, what do you call it? Like a creative guy trying to do an open source internet platform rather than becoming like a greedy, squeezing the margins out of people. So I guess Wall Street and him, they don't see eye to eye because Wall Street wants the CEO and the executive leadership team of GitLab to make more money from their platform and their services. But GitLab is like, dude, we're trying to be the good guys of the internet. And obviously, they're burning cash in order to operate their business. And I think, for me, that's not an alarming red flag because of the accelerating growth of their top line. You tell me, doesn't that look delicious, right? I think their free cash flow might not look pretty either because their stock-based compensation is pretty darn aggressive too, right? 2020 was $40 million in RSUs to their employees. I don't know what the vesting period is for them. Usually, from my understanding of big tech, it's usually like 3 to 5 years, which means you got to stay with the company for 3 to 5 years in order for your stocks to be converted. But that is something to note, right? So $200 million in stock-based compensation. And if we take a look at their free cash flow, and that's why it's kind of a messy situation. It's $35 million. But once again, I think with GitLab, I care more about their balance sheet, their books, and their top line. I mean, they have $1.1 billion of cash on hand to that of their total debt. I mean, that is laughable, right? $400,000 of loans. That's it. Are you kidding me? That means the net cash to debt situation is $1.1 billion of cash left over after you pay off all the debt. This is a company that is flush in cash. They're printing cash. And when you think about the future, I think there's going to be more and more apps being developed, produced, and who knows, right? Like tomorrow we might have the new Zillow or the new Uber. And GitLab is one of the hubs that these developers utilize in order to create and deploy mobile apps or software. So I personally am not a coder, but from a high level understanding, I just know that this is a really solid company that has the potential where if things go south, they probably will be acquired by Salesforce, Microsoft, or one of the other big tech companies. Because, doesn't their future just sound pretty lucrative? If someone that's watching this video, I'm rambling like an idiot, okay? My background is in pharmaceuticals and supply chain. Obviously, I am not an expert when it comes to mobile app development. Can you let the people know how important GitLab is? Anyways, this is a company where if they drop to 38, I'm in. I'm telling you right now, I'm in. Unless there's a catastrophic announcement like, hey guys, we're gonna do something crazy. We're gonna be spending $500 million to do a 3-day getaway for all the employees in Jamaica. If they say something ridiculous like that, obviously I'm not in. But we'll see how that goes. And then there's also UNFI. They are a private food label manufacturer for like Costco, Target, Walmart. Not too bullish about them. And obviously there's Manchester United, which always cracks me up to see a publicly traded Premier League football team. And it's kind of crazy to see, right? Like you can kind of see the financials and operations behind one of the biggest football clubs in the world. They generated $666 million of revenue or gross sales last year. So when you take into account their streaming share of the Premier League, the ticket sales, merchandise sales, $666 million. And then when you think about, let me see, are they profitable? No. I think when it comes to sports teams, I have heard that they burn cash in order to run the business because their employees, I'm not talking about the operations crew, the people that are in charge of the grounds, the pitch, the equipment managers, not them, but the players themselves, their salaries are ridiculously high, right? And so it's one of those things where you have to spend a crap ton of money in order to attract and retain the best talent. Otherwise, their agents are going to be flirting with Serie A or La Liga or some other football teams and they'll jump ship. So you got to be constantly increasing their salary at a ridiculous rate. So I'm personally a Tottenham Hotspur fan, but even if they were publicly traded, I would never want to invest into their stock. I think there's certain aspects of life where you can appreciate the product or service at hand. Doesn't mean you have to invest into it, right? I think a really good example of that would be Under Armour, right? I think Under Armour makes a fantastic product. And when I compare it to like my Nike apparel, dude, I have some Nike t-shirts in my closet that I've been wearing since 2005. No, they don't have any holes, and no, the collars are not stretched. But when it comes to my Nike stuff, dude, after like a year or two, it falls apart, right? I think Under Armour makes a fantastic product, but would I ever want to invest into this piece of crap of a company? Absolutely not, right? This is a hot mess. And I'm from the DMV, and I want to see companies from the DMV succeed. I think Under Armour's headquartered in Baltimore. We can throw them into the DMV, okay? DMV is basically the Washington, D.C. suburbs, which is my hometown. You take a look at their top line. This is stagnant of a company. I don't want to go near it, okay? But it doesn't mean that I can't appreciate their product and service, right? I still think it's high quality. But that is a distinction you got to make. Sometimes, just because you like something doesn't mean you got to invest into it, all right? We jump on over to Wednesday. So this is the big one, right? I think Salesforce, Snowflake, and Dollar Tree, I think that's going to be the headlines for Wednesday, right? I'm not shy about it. I'm invested into Salesforce. I'm pretty bullish about the company. I even made comparisons that they could be the next Microsoft. Because leading up to 2014, 2015, dude, Microsoft was a stinky armpit, okay? 4 days of not showering after hiking in the Appalachian Trail. Stinky mess. But in 2015, 2016, Microsoft started compounding into what they are today. A cloud, AI, monster of a machine. Salesforce, I think, is the undesirable, ugly Microsoft pre-2014. I think what we're seeing right now is the markets being so dramatic and selling out of this company and punishing them. I mean, their forward trading multiple is a 19.2. That's crazy talk. For a company that is this consistent and reliable in their top line, compounding throughout the ages, to be selling off like that, I've been buying the dip. And I've been vocal about it. I am buying the dip, and if it doesn't work out, it's going to suck. But my conviction for this company is pretty darn high. I think in the compounder chart, I think I have them as a B+. A B+ to me is pretty darn high quality, because I think S tier is Google, Amazon, and then I think A is Meta, and I think Salesforce is right below them. I don't think they're as high quality as the Mag 7, and that's why they're the Mag 7, but you take a look at their numbers, and I think this is just phenomenal. I mean, what the heck is going on here? Not available for growth. Actually, there is growth. It went from 40 cents every quarter to 41 cents per quarter, so this is not accurate. But the payout ratio, pretty strong and healthy. Actually, one thing that I do want to take a look at is, are they buying back their shares outstanding? Yeah, they are. It peaked at 2023 of 997 million shares outstanding, and they're buying back the shares. I'm pretty bullish on them. So let's break this down on a quarterly level so I can give you some commentary, because I took some notes. In Q2 2026, they reported their earnings back in like August or September or something like that, and it was just beautiful across the board, right? Their revenue went up by 10%. Their earnings per share was up by 33%. And for Q3, which is the earnings that they're going to be reporting for Wednesday, so it's going to be August, September, and October, they're forecasting $10.2 billion of revenue. So the guidance wasn't so great because it's going to be relatively flat going from Q2 to Q3, $10.2 billion of revenue. And their EPS is supposed to be $2.85. And as you take a look at the history of their EPS, that's going to be very ambitious, because the last time that they had pulled off $2.85 of profits per share was July of 2020. So because the expectation is $2.85 for their EPS, they can't just meet the expectation, they need to surpass it. We're operating in a market where, I mean, there are some stuff that's grossly overvalued, mainly Palantir. What's their PE right now? 366. And then Costco. Dude, I love Costco, okay? I think it's very high quality. But for a warehouse business that's selling household essentials, a glorified version of Target, to be having a PE ratio of 50 when their numbers are just growing at a single digit year over year, it doesn't make any sense to me, right? So this stock market that we're operating in right now, if you don't smash past the expectations and give a guidance that makes your dong like 3 inches bigger, they're going to punish the crap out of you. So I'm not going to be holding my breath on Wednesday, but if they do dip further than what they are right now, I guess I like pain and I like torture, so I guess I'll be dollar cost averaging. And their big push right now in Catalyst is Agent Force, which is their AI agents that will crunch all of the numbers and analytics in a digestible format, because for the longest time, you need someone on your team that manually extrapolates all of the data in numbers. But now Salesforce is upselling this service that does it all. So that if you are a product manager, if you're a marketing manager, if you're a talent acquisition specialist, whatever the heck you are, you'll have all of the high-level numbers that you need to see right there and then. You don't need to be crunching numbers. You don't need to be doing any manual manipulation. That's their big push right now. And I think between you and me, I think Salesforce will beat their earnings, but not by a significant amount. And I think their stock price is going to be contingent upon this. Okay. I think Wall Street's going to pay close attention to the adoption and revenue contribution from Agent Force. Because I think we're in an AI bubble. I don't care if you believe it in it or not. We are definitely living in an AI bubble. And if your business is not pivoting towards an AI revenue model, then I think Wall Street thinks of you as being replaceable in the future. And that's why I think Adobe, even though they're solid, they're crushing it. Because you tell me, does this look like a company that's being devoured by AI and is dying in the hands of AI? No. But I think what the issue is with Adobe, they're not monetizing their AI appropriately. I think right now they're integrating AI into their software. I use Adobe products every single day, right? But instead of like upselling, like saying you got to pay an additional $4.99 to use this AI feature, I think Adobe right now, they're just rolling it out and making a seamless feature for the users. And Wall Street doesn't like that. And so that's why when you take a look at their stock price, they're just being hammered. You tell me, do you think Adobe should be trading at a forward PE of a 14? I don't think so. Their historical PE, here, let me pull it up. I'm pretty sure it's a 50, but let me see. Let's see, Adobe's PE ratio for the past 20 years, on average, it's a 40.6, okay? Friends and family, it's at a 14. You tell me, right? I think they're doing phenomenal. I think the time will come when they're able to monetize AI appropriately, but I think Wall Street can just be very short-sighted sometimes, and they want these companies to just be as greedy as possible and squeeze the wallets of the consumers. And that's the fastest way for a consumer to jump ship, right? You have to slowly and do it in a more palatable way. I think Wall Street, they don't have the best optics, right? And so Adobe, even though I think it's a high quality company, I'm still scared to jump in. But if you're invested into Adobe, I honestly think this is a really good company. Okay, $22.14 of free cash flow per share. I mean, this is just phenomenal. This is a company that prints cash. And yes, there is the whole idea that AI can make videos, photo editing, and everything else that's in the Adobe suite obsolete in the future. But Adobe's not anti-AI. As a guy that uses their products every single day, AI is everywhere within their own platform. So all that to say with Salesforce, it really depends on how things go with Agent Force. I don't plan on selling out of them if they dip further. I will probably just dollar cost average, okay? And then what else do we have on Wednesday? Snowflake is a big one. I'll be honest with you, even after 5 years since their IPO, I still do not understand their business model. I know they're important for the cloud, but I don't exactly know what the heck they do within the cloud network, okay? So me personally, because I truly don't understand what the heck they do, I probably don't care about them. I know other investors care about them, and how do I know that? The proof is in the pudding. Their market cap is $85 billion. When you take into consideration their share price plus all the shares outstanding. So it's a lot. That's a big, large cap company. Dollar Tree, personally not for me, but I understand why people would buy into it. Because I think the high quality version of Dollar Tree is Walmart. If you're thinking about the low budget consumer buying cheap stuff with high volume and it's sticky, I think Walmart is head over shoulders better than Dollar Tree. Just my personal take. Because Dollar Tree just gives you exposure to the retail space, but Walmart gives you so much more than that, right? The Walmart Labs, which is the advertising arm of the business. There's e-commerce. There's the Walmart healthcare endeavors. Yeah, it's just kind of crazy to see the divergence of Walmart and Target. I feel like Target should be what Walmart is today, but Target, you know, I'm not shy about it, right? I've said it in the past. I think their leadership team for the past 5 years has just been so lackluster, especially the flip-flopping between the political aisle of their marketing and advertising within the stores. They alienated themselves from their core customer base, right? And their endeavors for the future, they're just, I don't know, dude. Target pisses me off. I just feel like they need to shake things up from the top down. I don't think their woes can be fixed from the bottom up. I think it needs to be fixed from the top. You got to get rid of everyone that blessed off the decisions of what they have been doing. I mean, let's look at their numbers as I talk smack about them. Everyone that's been blessing the decisions they have been making for the past 4 years, they've got to go. Everybody in the executive team, everybody in the board of directors, just clean house and start hiring external talent from Walmart and Amazon. They need to shake things up. They need to bring back that value add and differentiator, that customer experience. And then they also launched their own version of like Amazon Prime or Walmart Plus. You know that thing where you pay like 10 or 20 bucks a month to get additional features? I looked at the Target variety. Dude, it sucks balls. You literally get nothing. I mean, you get like free shipping and a little bit of cash back, but like the value add is so bad. With Walmart Plus and Amazon Prime, you get streaming, you get music services, you get this and that. With the Target membership, you literally get nothing. So this is a company that I think has big potential, but poor execution, and I think that's the fault of the leadership. And that's why when you evaluate companies, I think you should put more emphasis and pay more attention to who the hell is driving the ship. Because this is a company that is under serious mismanagement. Alongside with UPS, I just uploaded a video talking about stocks that I sold at a loss. I also think UPS probably has a top 10 terrible leadership in the S&P 500. I think Target is right up there too. But do I see Target getting bankrupt, turning into Macy's, JCPenney's, or Kohl's? No, I do not, okay? I think Target is high quality. They're just going through the ramifications and implications of terrible leadership. But I think the chief operating officer is finally taking over in 2026. So I think the ship's going to be turned around and things will look better for them. But again, that dude is just, he's been with Target for like 25 years. So all he knows is the mentality of Target, the way they've been doing things. And the way they've been doing things is not good enough. So there is that pushback from me as well. I feel like you got to bring in external candidates and shake things up. I think Target has so much potential to crush it in 2026. Just very poor execution. And speaking of the retail landscape, Kohl's, their stock price has been crushing it this year. Up 75%. This is an example of what I'm talking about. They're doing what Target can't do, right? They're pulling off this rebound story, and they're getting more bullish about their operations and whatnot. And I'm not exactly sure what the difference is that they're doing because I haven't taken a deep dive into them. But like Target, like they're not doing anything that's. I think they had a, skincare makeup collaboration this summer that went pretty well with like Ulta, and then they ended it. Why the heck would you end a catalyst that was going well for you? You know, it's like, dude, Target, you guys, dude, they piss me off. If you're investing into Target, I really do apologize, but like, dude, yeah, I'll just stop. And yeah, nothing too crazy on Wednesday. What about Thursday? A lot of Canadian banks are reporting, so I guess we'll get a snapshot of the consumer health in Canada, because usually the banks and the big retailers, it's kind of a proxy for how the economy is doing to get a real pulse check. Because I mean, right now, we used to rely on the jobs data provided by the government, ADP and everything, but now data doesn't seem to be transparent anymore, right? So I think it's going to be that much more important to tune in and listen to what the banks have to say, because if the banks are thriving, then that means the consumers are thriving for the most part. We got Kroger, Ulta. We were just talking about Ulta Beauty, right? Dollar General, Cooper Companies, DocuSign. This company literally gives me an aneurysm. I don't understand how they're still in business. They literally have an economic mode of making PDF documents more secure with your signature and everything, but like, how the heck do they have a market cap at $14 billion? I feel like in 2025, how the heck did they not get acquired by Adobe? right? Just integrated into the whole PDF Acrobat that they operate. But this is a company where I just truly don't understand the valuation. I don't see why anybody would be bullish about them going forward. I mean, obviously, I think there is that whole conversation of how paper documents is dead. Everything is now digitally signed, right? If you get hired onto a company, you don't sign a paper contract. You sign a digital contract that's going to be certified by DocuSign. So I guess that makes sense. But the whole idea of them getting this hammered, I guess that's where I would kind of disagree. Because I think they do have a place to stay in the future. But I think best case scenario for DocuSign, I could easily see Microsoft or Adobe buying them out. As a standalone company, it just makes my right nipple a little itchy to see that they make $3 billion in revenue to certify PDF documents. That's outrageous, isn't it? And that's why sometimes they say, like, if there's a boring business model that is high quality with an economic moat, like, that's a good business, right? And with DocuSign, I don't think it matters who's leading the ship. Dude, the CEO, he could go bowling and play golf all the time, and this company would still be thriving, right? So I think maybe I was a little harsh. Maybe this is a solid company, right? But would I ever want to invest into them? No, I would not, okay? So let's go back to the calendar right here. I think we were here on Thursday. And, Thursday, we have Rubrik. So this is a company that's been on my watch list since about July. I let the people know on Patreon that this is a company that I'm eyeballing. They're basically in the business of cybersecurity, and they run an antivirus cloud platform. And it's kind of interesting, okay? They assume that your IT infrastructure, if you're a S&P 500 company like Home Depot, if you are Best Buy, if you are Progressive Car Insurance, your data is going to be eventually breached. It's not a matter of if, it's a matter of when. And so their whole pitch is that they're going to ensure and protect your data, that the fact that it's going to be secure, and that if your company does get breached or hacked, they're not going to be able to reach any of it. So it's kind of an interesting premise, because we hear about it all the time, right? Companies getting threats, like once their data gets breached, the hacking groups will threaten them, and they're like, if you don't wire us like $1 million by the end of tomorrow, we're going to leak all of your customer data. And you would think an S&P 500 company wouldn't give into that, but they do. They actually pay the hackers in order to not have their stuff leaked. And so when you think about that, it's like, I think the whole idea of security breaches, and not just for companies, right? Even for physical security and protection, I'm pretty bullish on that, because I think we're living in a pretty interesting timeline where the executives of a company are no longer anonymous, right? They have a public LinkedIn profile, their photos are front and center on a website, and if a customer or a consumer or a member of society is just disgruntled with you, they're not afraid to do something about it. So I think physical protection in the form of bodyguards, I think that's going to be more prevalent going forward, but also protection for your data, right? The reason why I want to highlight Rubrik is, dude, these are some monster numbers, okay? 2021, $387 million. They're in the business, just as a reminder, once again, of cybersecurity. Now they're pumping $1 billion. Obviously, in 2024, it was kind of flat. Well, not flat, modest growth of 4.6%. But the fact that their revenue is just increasing at a more aggressive rate, 47% year over year, pretty darn ridiculous. And that's why I'm paying attention. I get it. They're not a profitable company, but I think 1 or 2 more quarters, and I think they'll cross that threshold into at least 1 penny of profits per share. But you take a look at their balance sheet, $1.5 billion of cash on the books to that of $1.1 billion of loans. So afterwards, you take into account paying off their debt with their cash, you have $355 million of cash left over. So even though they're burning cash in order to operate the business, take a look at their free cash flow. situation, $194 million of free cash flow, okay? So Rubrik is a company that I'm going to be paying close attention to. I'm not exactly certain whether or not I want to buy in, but if you think about the future trajectory of cybersecurity, I'm bullish. Okay, so this is a company that I do want to buy into, and I say that because back in 2020, a company that I crushed it with is Cloudflare, and I feel like it's a parallel industry. It's a web hosting, internet security type of business. They were like roughly $10 a share during the pandemic, and I bought into them. Sorry, like right here, okay? Roughly like $16 a share. And once they had this pop up to here, I sold out of it at about $100 a share. Had I just held on, freaking Cloudflare would have been $200 a share. So I didn't completely understand the business model of Cloudflare back then. But what I did understand was the aggressive growth of their revenue, right? 48% year over year, 50% year over year. And I was like, all right, I'm going to jump in. I feel like a company that's in the business of hosting web browsers and cybersecurity for that, I'm bullish. And I think at the time they were also, they weren't profitable as a business enterprise, but it doesn't matter because their share price has exploded throughout the years. So I think it's kind of the same line of thought for me. I just don't know what a fair price is. So I think that's my homework personally for myself. After I get done with this video, I'm going to try to calculate what a fair price for them is, and then obviously bake in a margin of safety. That way I don't overpay for them. By the way, shout out to Build-A-Bear Workshop. Until your kid turns like 12 or something like that, on their birthday, you can go to a Build-A-Bear workshop and get a teddy bear made for the price of their age. So if your kid is like 4 years old, you can get a teddy bear made for $4. No, I'm not joking. I'm being serious. This is really a thing. If you don't know what Build-A-Bear is, it's kind of like the mall retail shops where you can build a customizable teddy bear with the outfit, the everything, right, from top to bottom. Think of it as like a Mr. Potato Head, but teddy bear. So I'm definitely going to be taking my daughter to a Build-A-Bear workshop when she turns one, if we are in the U.S., okay? And anything else on Thursday? There's Smith & Wesson. I ultimately decided not to buy into this company. They're in the business of manufacturing and selling firearms. Historically, when there is when the administration is red, they sell off. When the administration is blue, that's when they have a bull market. And obviously right now, not a smart decision for me to buy into them. And back then, my train of thought is, I think this was back in like February, right? I was thinking about, okay, I think the military is going to get more pumped. It's going to get more juicy. So I wanted to figure out what is the best undervalued companies to buy right now in the military space. And that's why Smith & Wesson came into my my sights. Ultimately, I decided to buy into Huntington Ingalls. I bought into Oshkosh Corporation, Lockheed Martin, and it panned out pretty well. Right, I think I'm still holding on to my military stocks, and I'm up like 80, 90%. So pretty happy with how that panned out. But had I bought into Smith & Wesson, I don't think I would be as thrilled, because February was when I was researching them. I think they were roughly like $10 a share. And I would probably be negative, like 10% if I had bought into them. Yeah. I think rather than Smith & Wesson, I don't know if you guys are a firearms kind of a guy. I used to go to the shooting range all the time. I was an infantry officer. My buddies and I would go to the shooting range. I'm more of like a Sig Sauer kind of guy. Smith & Wesson, I'm not that bullish about on a personal level. So, yeah. There's Duluth Holdings. By the way, I'm in the market right now to buy basic tees. I decided that I dress too much like a teenager or like a college student. So I've been trying to replace my wardrobe and try to dumb it down, right? Go back to the basics of wearing like a basic black cotton tee. So I've been buying one shirt from each company, like Fruit of the Loom, Hanes Beefy, Uniqlo, just trying everything out. And apparently Duluth, their basic tees were like 10 or 15 bucks a piece, but apparently it's pretty high quality. So I don't know. And I don't know if there's anything on Friday that's worth mentioning, but let's see. Korn Ferry, absolutely not. They're in the business of headhunting, finding candidates for open jobs, but they also do like leadership psychology surveys. Not bullish about them. You want to see why? Here, take a look at this is a company that I interviewed with during the pandemic, and I made it to the final round to join their consulting team. I didn't get it, obviously, because they hired a guy that went to the same alma mater as the hiring manager. Was kind of salty about that because they were like buttering me up, like, dude, Amos, we can't wait for you to join our team, blah, blah, blah. And then, didn't get the final offer. But you take a look at their revenue situation. I mean, it's pretty much stagnant since like 2023, 2.8 billion, 2.7 billion, and we can round up. This is a company that I don't think is thriving and is not doing too well. I'm not feeling bullish about them. Actually, I take that back because their EPS is looking pretty good, so their profitability is going through the roof. I'm going to go ahead and assume they're firing people, so they're doing more with less. We can confirm that with the SG&A. Take a look at this. So it's going from 258 to 259, so it's staying pretty stagnant. So I don't know. I did so much homework on this company, so much networking in order to get in. I guess on a personal level, I just salty. Maybe it is high quality, right? Take a look at their free cash flow. Dividend profile. All right. Their numbers look pretty good. I'm still salty though, okay? Gosh. Let's see, Thursday, Friday. Was there anything else that was crazy? Because if there's not, we can go ahead and talk about some of the Wall Street news that I wanted to give you guys some of my inputs with. So, all right. So the first thing I want to talk about is this Wall Street article talking about American consumers have had it with high car prices. Shoppers are downsizing, buying used vehicles, taking on longer car loans, and holding out for deals. Dude, I just talked about that, and I've been vocal about it this entire year. I think the car market in the United States right now is ridiculous. Yes, I live in Japan. No, I can't even buy a car in the US. But something I like to do when I sit on the toilet is I like to, window shop cars and in homes on Zillow with no actual seriousness in pulling the trigger. Something I like to do. And something that grinds my gears is just the fact that the used car prices in the US are literally the same as new car prices. And the fact that they're trying to charge money, like in a subscription model, to get basic features like using your key fob to open the door from 15 feet away. Dude, that just makes my butthole sweaty, right? And I think there was something that I wanted to call out in this article. There was something here. Oh yeah, right here. Signs of strain are beginning to show up in the data. Cars are sitting longer on dealer lots. Dealers are piling on extra discounts to make sales. Lower income borrowers are defaulting on car loans. Americans as a whole are spending less overall on vehicle purchases than they did a year ago. Dude, I can't blame you guys. I feel the frustration and anger for you on your behalf. I think it just grinds my gears to hear that, so before I moved to Japan, I sold my little Honda for like $2,800, right? That exact same Honda, after all these years, is now like $7,000 to $8,000. And nothing changed. It's not like it magically got better fuel economy. It's not like it got better features. That piece of crap Honda is now like 200% the valuation that it was when I sold it. Like, that's ridiculous. So if you're in the car market in the US, dude, I feel for you. I think it's stupid. And if you're that kind of person that's trying to sell a freaking Honda Odyssey with 250,000 miles, a 2004 piece of crap minivan on Facebook Marketplace for $20,000, you're a part of the problem, man. And I get it. The Kelley Blue Book, the JD price valuation says, oh, but the market value, dude, screw all that, dude. Just give a good price. You really think someone is going to wake up one day and try to buy a freaking 250,000 miles on the odometer minivan because they're in a well-off position? No! It's going to be usually a struggling family, right? They've got kids. They need a minivan. Don't sell it for $20,000. Come on, right? Sell it for like $2,000, maybe like $1,000. Maybe even give it away, right? I don't know. So this article confirms what I was talking about this entire year, where I feel like the car market is just ridiculous right now. It's ridiculous. Something else that I want to talk about is this article. America loves a $13 lunch bowl. Don't bet against it. Consumers may be struggling, but they still want fresh and fast offerings from restaurants like Cava and Chipotle. And the reason why I bring that up is because I think this article will have a graphic. Chipotle, Cava, and Sweetgreen, they're all getting absolutely decimated this year, okay? I think it's because all of their numbers are growing, okay? I think Cava and Sweetgreen are unprofitable, but all of their numbers are growing. It's just the guidance that they've been giving is not so bullish, if that makes sense. And it's just crazy to see that Chipotle, I mean, their stock price went from like $50 down to like $29, which is pretty crazy, right? And this article says companies point to the same culprits: student loan payments, higher rents, and a softer job market that are pushing younger consumers back into their kitchens. And when young people stop spending, fast casual feels it first. Roughly 75% of the customers for these chains are Gen Z or millennials. So I think this is a really good reminder for me to probably reassess and evaluate Chipotle again, because I am a shareholder of Chipotle and I'm thinking maybe it's a good time to dollar cost average, right? How do you guys feel about that? Like, I do agree with the sentiment that when times are hard, I think people do eat out less and they start cooking more at home, which is why I'm, holding on to my grocery stocks like General Mills and PepsiCo. But I also think I think eating out is ingrained in one of our activities, right? Like dates or lunch breaks or coming home from work, because not everybody wants, after a 12-hour shift at UPS, throwing boxes around all day, not everybody wants to turn on the grill to cook. Like, I don't know how y'all are dealing with the inflation situation in the U.S., but in Japan, it's not so bad. But I know that in the U.S., the cost of groceries is pretty high. So when it comes to spending $10 to do groceries versus $13 for a bowl of like fresh ingredients, protein, and vegetables, I think for me, on a psychological level, I think the younger ones, they're going to continue to buy Chipotle and Cava and Sweetgreen, right? Maybe not Sweetgreen. I'm not too bullish about them. Cava, I can see why people buy into them, especially with Chipotle. So what are your thoughts? Do you think these guys are cooked? Regardless, I'm a McDonald's shareholder, and when the times are good or when the times are bad, I think everybody likes McDonald's, okay? So maybe it's time for me to buy more shares of McDonald's. By the way, I wanted to say that word one more time because earlier I had a tongue twister, right? Borrowers. Okay, whatever. So before I get out of here, I guess personal life. Something that I'm discovering about myself is that I think, in fact, I am an introvert. I know on camera I come across as a loudmouth, as an extrovert, and just really energetic at times. But these past few weeks, I've been going to a men's group because I decided, I'm not lonely. I'm not anything fill in the blank negative. But I started going to a men's group ever since my daughter was born because I feel like I need, like that 2-hour break to get out of the house. Because I work from home, right? I upload videos almost every single day. And I've been reading articles that say it's healthy to get like a mental break every once in a while instead of just being at home. So I've been doing that and talking with men that are in their 30s, 40s, 50s, and 60s, and we're just talking about our lives and everything. And the facilitator said something that just kind of stuck with me, right? He's like, dude, Amos, you're really freaking quiet. And I am. In public settings, if you ever meet me in the wild, I'm pretty well-mannered, quiet, and reserved. And he straight up called that out. He's like, dude, you're so freaking quiet. And he's like, you only say one thing in the entire 3-hour session. But when you do say something, it tends to be a mic drop. And I'm like, that's a stark contrast to how I used to be. Because I think when I was younger, I didn't have a filter and I just said whatever came to mind. But I think the older that I get, the more that I realize I don't need to say that much in a group setting or in a public setting. Sometimes less is more. And I thought that was kind of an interesting discovery about myself. It's like, I guess on camera, I'm myself in a way where I'm like excited to talk to you guys about what I'm passionate about. But in person, I'm also myself in that I'm reserved. And you would think, like, there's no way that this dude makes YouTube videos. He's so talkative, well-spoken. Because in person, dude, I'll literally just be the one where if you're sharing a sob story, I'll be there for you, man. I'll give you a shoulder for you to blow your nose on. Sometimes I don't even have to say anything. And by the end of it, the dude on the other end will be like, dude, thanks for being there. And I'll literally have said one word. And I think I'm learning that in life, sometimes just being there and showing up, that's half the battle, right? Not everybody wants advice. Not everybody needs you to tell them what to do. Sometimes when someone's going through a tough time, you just got to be there. Just show up. Just sit next to them. Cry with them. You know? I don't know. Just kind of something that's outside of the realm of the stock market that just wanted to share with you guys because I consider you my friends. If you don't consider me your friend, well, that's all right. But I consider you guys my friends. Having said that, yeah, hopefully you enjoyed this episode. And obviously I'll make improvements next time. I feel like it was all over the place. But having said that, I'll be praying for you guys. I care about you guys. Good luck in the stock market, and please stay safe, okay? I feel like during the holiday season, we let our guards down a little bit, but there are some crazies out here. So stay safe, have some situational awareness, look over your shoulder from time to time when you're in public, and yeah, I'll talk to you guys really soon. See ya.